I think rising wages will really be the tipping point. A wage price spiral will start probably by the end of the year at the latest, and this will really be the main driver for rising inflation rates over the next couple of years.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is Ronald Stöferle. He's the author of the In Gold or Trust Report. Ronnie, thank you so much for joining us today.
Thanks for having me again.
Your new In Gold or Trust Report 2021 was just released, and you talk about this climate change that's happening in the financial markets. I just want to read this quote here from the report. It says, "The trust in the future purchasing power of money is on the brink of collapse, as currently evidenced by the crack-up boom-like developments in the financial markets." So do you want to take our viewers through that view, kind of why is there this climate change? Why is there this fundamental shift in the way that the financial markets are operating right now?
Well, the title or the leitmotif of the report is the monetary climate change. And of course, it's a bit provocative, I would say. But, topics like climate change and sustainability are really omnipresent issues today. And we're seeing it, from energy production to mobility to the food industry and retail to green government bonds, whatever. Everything is climate neutral. And ESG and SRI and all those topics, there's just, everybody is just talking and writing about it. However, I think from our point of view, it is at least equally important to talk about our monetary system. And as we know, this year marks the 50th anniversary of its birth, which is ironically the final separation of the world monetary system from gold. Will celebrate its golden wedding on 15th of August 1971. And the consequences of, let's say, the end game of this monetary system are probably even more important than the other climate change that is going on. So this is really crucial for us to explain, to inform our readers about, to take a deep dive into those topics. And I think when it comes to this crack up boom development that we're seeing at the moment, I think Ludwig von Mises, when he wrote Human Action, I think if he would still be alive, he would definitely say, well, this feels and smells like a crack up boom. People are losing confidence in the purchasing power and especially in the future purchasing power of money. And it's no coincidence that we're seeing those booms in real estate, in equity markets, in the crypto space, obviously, in the commodity space, in Pokemon trading cards, in the wine market, in the art market, everywhere. People are losing confidence in the future purchasing power of money. And that's obviously a very, very dangerous development. Now, central bankers keep telling us that inflation now is only transitory, but from our point of view, it is not a transitory development. It is really a structural change that we have seen over the last couple of months, a structural change in the way how money is created.
Now, getting into some of those structural changes, one of the ones that you mentioned is budgetary nonchalance. It's essentially this fiscal conservatism isn't in existence anymore. How is that impacting the financial system?
Well, in short, austerity is out. Over here in Europe, we had, especially after the Greek crisis, we had the credo of the frugal Swabian housewife, a balanced budget, even making budget surpluses. That was kind of the zeitgeist over the last couple of years. I mean, this is over for now. And I think that big government is back, and I think that politicians really feel pretty well and comfortable in their positions now. A big government is back from my point of view. Now, it seems that all constraints, be it national debt breaks or debt ceilings, or in the Eurozone, the Maastricht criteria. This is basically interpreted very generously or now being simply ignored, and nobody cares about it anymore. And this leads to this development that we forecasted already a while ago. We always said, well, if you listen to central bankers, what they are telling us, they basically say, well, we are running out of tools. Our toolbox is basically empty. We can do quantitative easing and all this kind of stuff, but it doesn't have a big effect anymore. It is the time for fiscal policy to take over. And this is what happened last year. And I think really this change that we're describing from monetary dominance to fiscal dominance, this has enormous consequences. And I think one of the main consequences is that compared to monetary stimulus, fiscal stimulus works much more, much quicker, much faster, and much more direct on the economy and on inflation. It's like if you're pouring 2 Red Bull or 5 espresso, energy kicks in pretty quickly, but then it fades off very quickly as well, and afterwards you feel horrible and depressed. So we will see much more fiscal stimulus. We will see creative reasoning for new infrastructure programs, education, healthcare, whatever, green energy, you name it. Yeah? So there will be much more packages, much more fiscal packages. And I think this is really a major shift, and this also is one of the main reasons why we are already seeing higher inflation rates. And I mean, just have a look at commodity markets. Commodity markets are screaming inflation at the moment, and I don't see that this will fade out or level off quickly.
No, one of the things that you mentioned in Gold We Trust report is that essentially there's a lot of asset price inflation, and this is kind of the crack up boom that we're seeing. We're seeing the stock market rise. We're seeing, cryptocurrency rise. We're seeing the housing market rise. We're seeing everything rise at the same time. But when it gets to really consumer price inflation, it's not as dramatic. I mean, obviously in the US, we're seeing, 10-year highs or whatever in inflation, but still it's not like the 1970s level of inflation. How are we going to transition from asset price inflation into consumer price inflation?
Well, I think that the playbook based on the Austrian economics and especially on Rothbard is pretty clear. First, there's monetary inflation, then there's asset price inflation, and only the third stage is consumer price inflation. And clearly inflation is a topic again. And that's why we called our last special report that we published in November. It was called Inflation and the Boy Who Cried Wolf, because many commentators were warning of inflation already in 2008, 2009, and in 2011 and 2013, and nothing happened. And now many of those are totally ridiculed, and nobody thinks that it could really be something that is not transitory. But I mean, market-based inflation expectations are at a 10-year high. We're seeing 10-year break-even also close to a decade high. We're seeing University of Michigan consumer survey jumping. We're seeing 5-year expectations hitting a decade high. So inflation is a topic again. And of course, those inflation indicators, they are always telling us what happened over the last couple of months. So, markets are looking through through the windshield and not into the rear view mirror. So from my point of view, the market, especially the bond market, is still seeing, well, inflation might be a concern over the next 1 or 2 years, but for the longer term, nobody's really scared of inflation yet. And this is also the reasoning why we saw this flattening of the yield curve recently, with the 30 years coming down significantly. So over the longer term, actually inflation was priced out recently. However, I think that when it comes to inflation, there's quite a lot of interesting things that happened and that lead us to the conclusion that we're seeing a monetary climate change. Well, first of all, we're seeing this move from 2% being basically the ceiling now to average inflation targeting. This gives the Federal Reserve enormous leeway, because they say, well, over the last couple of years, inflation numbers were too low. Now we can let inflation numbers overshoot over the next couple of years. Then we're seeing, as we talked about before, we're seeing this move from monetary dominance to fiscal dominance. Then we're seeing, which is really, really important from my point of view, if you listen to speeches by central bankers nowadays, be it in the Eurozone or in the US, they sometimes sound like Greenpeace activists or social workers. And I really don't want to judge that, but it is not the mandate of a central bank to fight climate change and fight inequality. So those are mandates that they have taken on for some reason, but they're not, there's no laws behind that. But it is obvious that climate change, but also rising inequality, where I would say that central bank policy is also quite responsible for it. Just Google Cantillon effect. That those are topics that are taken into consideration much, much more than previously. Then I would say that, we're seeing some sort of a shift to a second Cold War. We saw that with the last summit between the US and China, and now also with the G7 summit. China is the big enemy now. And Asian countries are starting to export inflation rather than deflation. That's a very, very important thing. Another thing is that demographics are turning inflationary. We dedicated a big chapter to that. And then we're also seeing that a fundamental break in the way how money is created has occurred. So we're now seeing that governments are basically giving out credit guarantees, which for every banker will say, well, if there's a credit guarantee backed by the government, well, of course I'll hand out this loan. There's no risk for me involved. So from my point of view, there's many structural forces that are now becoming stronger. Of course, there are still deflationary forces, but I think the pendulum is swinging in the direction of more of stronger inflationary tendencies. But long story short, to answer your question, Elijah, I think rising wages will really be the tipping point. We're seeing a shortage of labor in certain industry. We're seeing rising minimum wages. We're seeing globally rising unit labor costs. So from my point of view, a wage price spiral will start probably by the end of the year at the latest. And this will really be the main driver for rising inflation rates over the next couple of years.
Your perspective then on how high inflation is going to get? Is it going to get to double digits?
I cannot rule it out, but I would say that 4 or 5, 6% will do the job. And actually, it is not a conspiracy or anything. This is exactly what central bankers and politicians keep telling us. We need more inflation, and now it's happening. But everybody says, well, it's only transitory. And if you read history of financial markets and of money, Well, I think, we had debt levels at similar levels, but only in during war times. And the solution has always been a combination of inflation and financial repression. So at some point, I think the bond markets will get nervous, probably as soon as the Federal Reserve continues on this path that is slightly more hawkish. I mean, from my point of view, what happened recently, I don't really see the big U-turn by the Federal Reserve. But it's clear that they would like to step on the brakes. But it is like, if you're massively overweight and you say, well, I'll start with my diet in 2 or 3 years. Well, okay, good luck. So it seems that they really want to try to at least sound a bit more hawkish. But I just don't see real interest rates rising significantly higher. And I think at some point, probably at 2% for the 10-year bonds, I think there will be a yield curve control being implemented. There's no other way that I see. And this in combination with higher inflation rates, I mean, that could solve some of the debt problems. I don't see I don't see a big restructuring going forward. I think inflation, as always in history, will be the solution.
You mentioned in the report about these real interest rates remaining negative. You say that we believe that real interest rates will remain in negative territory for the next decade. In such a market environment, tangible assets, especially commodities, selective equities in the right sector, and obviously precious metals should form the solid basis of the portfolio. So your perspective on that, what do you mean by solid basis? Because that is very non-traditional, right? The traditional is that 60-40 of stocks and bonds, but you're talking about tangible assets and stocks in the right sectors really forming, it seems like, most of your portfolio, if I'm reading that correct.
Well, of course, I mean, it depends on your time preference, on your age, on your overall portfolio. But I think that the big advantage that private investors have compared to institutional players is that they can have a much more active asset allocation, and that they can actually buy physical gold, while for a pension fund over here it's impossible to buy physical gold because it's too risky. But for some reason it's no problem to buy Greek government bonds with negative yields. It is what it is, yeah, and that's also a consequence of financial repression, where money is funneled into investments where it would not go to in a normal market environment. But I think this allocation that you just quoted, I think it makes sense in times of rising inflation and negative real rates. And I think one of the main takeaways of the report is that in times of rising inflation, the classical 60-40 portfolio doesn't work anymore, because most people think that, well, okay, if equities are in a bear market, if they're volatile, well, that bonds will basically make good and will basically hedge that. Well, this correlation between this negative correlation between bonds and equities, out of 90 years, we had it only in 20 years. So as soon as inflation rates become unanchored, so as soon as people believe, well, inflation is here to stay, this correlation flips. And then, of course, you've got a problem on the equity side, but especially on the bond side. So I think this is really, really crucial to understand. And every time I talk to investors, from Brazil, from Turkey, from high inflation countries, they've got a completely different attitude when it comes to asset allocation. For them, gold feels just more normal. For them, government bonds aren't really a safe haven. And of course, when it comes to equities, I think it's another interesting outcome or finding of the report. Then that in general, equities aren't the best inflation hedge. The highest inflation beta is shown by, first of all, by commodities, followed by gold and then silver. So those three really can hedge you from rising inflation. When it comes to equities, it really depends on the sector, on the pricing power of the company, how they deal with rising input prices, how they're financed. So then it really goes into the, how do you say, the nitty gritty, and you really have to do your homework. There are lots of companies with fantastic products and they profit from rising inflation, but there's many sectors that actually suffer from it.
You mentioned in last year's report regarding kind of the price prediction for this decade for gold. It was 4,800 to 8,900. In this year's report, you're saying, if I read it right, that you're kind of looking for gold to be on the higher end of that range because you're expecting inflation to be so high. So did you want to expand on kind of your price prediction for gold this decade?
Well, we say we cannot rule it out, the higher price target. Just to recap, last year for the first time we introduced our readers to our long-term model, which is basically based on monetary growth and confidence or trust in the monetary system. And we said that we see the highest probability at $4,800. Now, this sounds like quite a lot, but it is only 10% compounded annual growth until the end of this decade. So that's clearly possible. And I mean, gold was up 25% last year alone. So we still stick to that. If it should really become a highly inflationary decade, then this $8,900 cannot be ruled out. Now, this sounds like an incredible price prediction. But if you would have talked to people in 1971 and said, well, in January 1980, gold will be at 850, people would say, well, stop drinking or stop smoking weed or whatever. This is just impossible without seeing hyperinflation and, riots on the street, whatever. But it happened. So we cannot rule that out. People tend to forget that in the end of the 1970s, the US, because nobody really trusted the US dollar anymore, had to issue debt denominated in Deutschmark and in Swiss francs. So at some point, we might see that people are losing confidence in paper money and in be it the US dollar, the euro, whatever. And I think we got much closer to this stage last year, because let's face it, $1 trillion used to be a big number. Now nobody really cares about those numbers anymore, and I don't see that we are going back to the old regime, to this frugal Swabian housewife anymore. So therefore I think if you study history and in German we say Geldgeschichte ist Weltgeschichte, so most of the books in my library are really about financial markets history, then it's fairly obvious that the purchasing power of fiat money will continue to decrease and probably decrease at even a faster rate.
Then your outlook for silver as well, because a lot of people are actually more bullish on silver than gold.
Well, last year we dedicated in the In Gold We Trust report for the first time a special chapter on silver, and I think it was spot on, because back then the gold silver ratio was trading at 125. So for 1 ounce of gold, you got 125 ounces of silver. It came back dramatically, so silver outperformed gold big time. It was up, I think, 45% last year. And we still like silver at this stage. I think what's going on currently with this massive takedown over the last couple of weeks, I wouldn't expect too much from gold and especially silver over the next couple of weeks. But for a long-term investor, I think it's a nice entry point probably. I think that silver should profit from this whole green wave that we are seeing. It started in China and then in Europe and now also in the US. Many industrial appliances that are heavily subsidized, where silver demand will profit from. Then we're seeing from the supply side, I think, very interesting developments. Let's have a look at what's going on in Peru. Peru is the second largest silver producer and has the largest silver reserves. We'll see how this is going to play out after the elections now. So yeah, if you have a look at this chapter, the main takeaway basically was that our view is different to the consensus view, and we see strongly rising investors' demand, and if you have a look at physical deliveries, I think with the whole silver squeeze in February, I think it changed quite a lot, and silver is really back on the watch list of many people, and many people are really studying the supply-demand characteristics of silver at the moment. So I think, silver, if you're bullish on gold, you should at least own some silver. I think the supply-demand setup is highly interesting at the moment.
All right. Well, Ronald Stöferle, thank you so much for joining us today. Before we let you go, did you want to share with the viewers where people can get the complimentary report, and also if they're interested in the expanded version, to find that as well?
Sure. Well, the report is available totally for free. It wouldn't be possible without the support of our premium partners. You can download it, the extended version, 350 pages, so should be good reading material for your vacation. On our webpage, ingoldwetrust.report. There's also a compact version with most of the highlights. It's just 20 pages. You can also download it for free on our webpage, ingoldwetrust.report. I'm pretty active on Twitter. My handle is at Ron Stöferle, and you can have a look at our investment funds and our wealth management department at incrementum.li.
All right. Ron Stöferle, thank you so much for joining us today, and God bless.
Thank you very much, Elijah. Have a great summer, and I look forward to talking to you soon again. Bye-bye. Thanks.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.